The Federal Reserve has decided to hold interest rates steady as the war with Iran has consumers worried about the American economy. But with the February pending existing home sales index released on Tuesday, is the housing market going to flourish during the war? And what does this mean for your wallet? Bankrate financial analyst Stephen Cates joins me now to give me his insight. Hey, Stephen.
How you doing?
Good, good. Thanks for joining us. And this decision to not cut interest rates is not unexpected, but how much of a part does the war, increased oil costs and inflation impact the decisions we'll see the Fed make this year?
Well, I think that whether we had this conflict or not, I don't think that the Fed would have cut interest rates at this meeting. So I don't think, although they did address it as a concern, going forward, it's not something that probably changed the calculus for the committee members. We're seeing inflation starting to rise, and that was before this oil shock actually took effect. I think that's the bigger concern here, and how that plays out over the next few months is going to dictate how much and when we actually get any further cuts.
And as you alluded to, interest rates have been in conversation in recent years, and the average cost of a 30-year fixed mortgage rate is about 6.19%, still close to a 3-year low. Will inflation and interest rates not remaining steady help or hurt mortgage rates?
It'll hurt them. If we see inflation starting to get worse, what that's going to do is push up bond yields. The 10-year Treasury is what really moves mortgage rates. And so at this point, if borrowing rates for 10-year treasuries, long-term treasuries start to move higher, whether that's because of inflation concerns, whether that's because of instability in the globe or concerns, let's say, about the U.S. debt situation, whatever pushes that higher will push mortgage rates higher. And that's going to make it harder for people to borrow and reduce their buying power when they want to go out and get a home.
And something else to note, in February, housing affordability improved. Are we likely to see rates hold steady, or are the market's concerns likely going to raise prices again?
Well, mortgage rates are higher, actually, than what you quoted. Just in the last few days, they're bouncing around closer to about 6.3% on average. Now, if you have a good credit score, you're going to get a rate lower than that. But for the average person, those rates show that borrowing costs are higher, will be higher. And until we get more clarity around the conflict, around inflation, we're probably not going to crack that 6% level again. And that may be a bit of a demotivator for a lot of people.
And for those that are concerned about prices becoming less manageable, what should they do to decrease those financial concerns?
This is a really tough one because there's two ways to give yourself a little bit of breathing room in your budget. You can cut costs, you can increase income. For most people, one is easier than the other, but you can only cut so deep. Now, it is a good idea to go check and see if there are any subscriptions that maybe you're not using, you can cut, that maybe there are areas that could be more efficient, or you could better position your dollars for the priorities that you have today as opposed to the budget you set a few years ago. But over time, increasing your income is going to be the best and only answer to growing into what is ultimately rising expenses. So everyone should be trying to find ways, whether it's to growing within their job and earning more income, taking on side work, or somehow adding to whatever it is that could supplement their income, because that's going to be the way that people start to grow out of the pressure of inflation. And for the most part, that is going to take some patience.
Some good information there. Bankrate financial analyst Stephen Cates, thank you for joining us.
My pleasure.